Welcome back to another video for HarborFinancialOnline.com. Today I'm going to be talking about long-term capital gains tax rates and what that rate might be for you when you're filing your tax return. So let me get the video going here. So a long-term capital gain occurs when a capital asset is held for more than 1 year before it is sold. The current long-term capital gain rate is 15%, which is a lot less than the short-term rate. So there's a big difference, which we'll go into a little more detail later. There are also capital losses, and the IRS does not require you to report them, but you should, because you can qualify for a $3,000 loss deduction. That is the maximum amount you can report each year for a loss is $3,000. But luckily, you can carry, if you have more than $3,000, you can carry that to future years or back to older previous years. You can amend an old tax return. Say where you owed tax, you can apply this loss to a previous tax return and probably get a refund. And you can, if you had say a $21,000 loss in a year, that would be 7 years you could do a $3,000 loss. So there's no max on how many years. You could just 7 years in a row do a $3,000 loss, a $3,000 write-off, which would have a big effect on your taxes and your refund most likely. One thing you do want to look at when you do report these capital sales, when you're selling stocks and you have to report it on your tax return, is a wash sale. This occurs when an investor sells a stock and then repurchases the same or similar stock within 30 days. That way, if you do that, you won't be able to report that loss and get the tax advantage of that loss. With each sale of stock, you should attempt to sell it when it qualifies as a long-term sale. You're going to have a much lower tax rate, that 15% tax rate, if you can get it in the long-term bracket, which is a year or more. You report all capital gains and losses on Schedule D, which is part of your 1040 tax form. When you're dealing with these capital gains, this is why I always recommend, if you can file the return with electronic software, it's going to bring in that Schedule D and fill out the form for you. You just answer some easy, quick questions on the statements you received about your stocks, and it's going to automatically fill out that Schedule D, which gets attached to your regular 1040 form. Trying to fill out that Schedule D on your own is just going to lead to problems and mistakes on your return. So I always recommend doing it online because it has an error check, which you can do right through our site, HarborFinancialOnline.com. A capital investment is any income earned from the sale of stocks, a house, a farmhouse, bonds, and securities. Normally, you don't have to report the sale of your house as a capital asset because certain rules apply. If you're married filing jointly, if you have a net profit of your house of $500,000 or more, then you have to report it. If you're filing single, if you have a net profit of $250,000 on your house or more, you have to report it. Anything under that, you don't have to report it. You do have to report any income from the sale of a rental home or vacation home, no matter how much you make on that house. But same thing, you can report losses for those, for a vacation property or rental home, and get that deduction. You can also deduct the cost of improvements for that capital asset, which will lower the net gain. Remember to keep accurate records of the purchase price of your capital asset and the sale dates. That's very important. A lot of times when you get the records from, say, the bank of when you bought that capital asset, they're not going to have the date when you sold it, just the date when you purchased it. And with stocks, they may not have all the dates you purchased it, so you're going to have to keep those dates and those records for yourself. I wouldn't count on the broker giving you all the information you need. I often recommend timing the sale of your stocks to take advantage of the lowest rate possible. So if it's you bought the stock in January and it's November, you're considering selling it, wait till the next January so you can fall into that long-term bracket. Any IRS statements that you get from your brokers, any of the statements you get from your brokers, the brokers are required by law to send those same statements to the IRS. So whatever information you're reporting on your tax return, make sure that lines up with your broker statement, because the IRS already has a copy. If those numbers don't go together, you're going to probably have a problem. So let me take you to our site real quick. This is harborfinancialonline.com. We do have a page devoted just to capital assets. So if you want to learn more about wash sales, how long you can hold it and give you a long-term asset, I'd recommend checking out that site at harborfinancialonline.com. And through the site, you can prepare your return directly online and use the free online calculator. Thank you for watching the video today. I helped you guys understand the long-term capital asset tax rates and how that works. Again, it's just a flat 15% for a long-term capital asset. And thank you again, and we'll see you soon.